Hello everyone, and welcome to another lesson on Grade 12 Accounting. What we're going to be doing today is a question on an income statement as well as asset disposal. Very possible that you will get a question on the income statement in your end of year exam, and so you'll have to know the section very well and prepare it before you start. Let's have a look at this question. This is one of those typical long questions which provides you with a pre-adjustment trial balance. So there's going to be a whole lot of information over here, and it's going to be up to you to take this information and produce either an income statement or a balance sheet, or both, depending on what the question is asking you. So let's have a look at the first question. The first question is an asset disposal question, and it says that you are provided with a pre-adjustment trial balance of Anisa Limited for the year ended 30th of June 2011. It's very important always to know when your financial year ends, particularly when doing asset disposal, because you're going to need to know when a vehicle is sold or when a vehicle is bought during the year. It's very important to know the beginning and the end of your financial year. So, the question is asking us to prepare the asset disposal account to record the sale of vehicles, and it's telling us to see information G and H under the adjustments below. So let's have a look at what the information gives us. We'll have to skip through some of the other adjustments. You'll see it starts with A. The question tells us that only adjustment G and H are relevant. So let's have a look at what they say and read them together. So the question says that a vehicle was sold on credit for 90,000 Rand on the 31st of December 2010. There are three pieces of information that are important here. First of all, we need to be very clear that we know that the vehicle was sold on credit. Secondly, we need to know what the selling price was. You see, that's this 90,000 Rand. I'm just writing the selling price here so that I don't get confused. And we also know that the vehicle was sold on the 31st of December 2010. That's going to be important when it comes to working out this year's depreciation. Now, let's have a look at what it says about the fixed asset register. It says that the vehicle has a cost price of 235,000 and an accumulated depreciation on the 1st of July. Remember, that is the beginning of the financial year. How do we know that that's the beginning of the financial year? Remember, I said to you, it's important to know when our financial year ends. And the question told us that our financial year ends on the 31st of July, on the 30th of June 2011. So that means that the starting date should be the 1st of July 2010. So we've been given the accumulated depreciation at the beginning of the year, and we have been given the cost price. Now, here's where your prior knowledge comes into play. You need to know what goes into the asset disposal account. We're lucky that in this asset disposal account, they've actually given us a lot of information already. You can see there they've printed for us vehicles on the debit side, and they've printed for us accumulated depreciation on the credit side. Not every question will do this, so you need to know the format of the asset disposal account very well. What we're going to do is our first step in asset disposal is always to record the cost price on the debit side of the asset disposal account. So in our information, the cost price was 235,000. So the first step will be to record 235,000 in this block over here. That is the cost price of the vehicle that I have sold. Our second step is to record the accumulated depreciation on the credit side. But here you have to be a bit careful. We need to, on that credit side, record the accumulated depreciation up to and including the date of the sale. So if you look at the question, we only have depreciation up to the 1st of July. In other words, we have only the accumulated depreciation at the beginning of the financial year. But we haven't just sold the vehicle on the beginning of the financial year. We actually sold it on the 31st of December 2010. So we are going to have to record additional depreciation in order to get the right number in our asset disposal account. So the first step would be to take the accumulated depreciation of 105,750 and just record it somewhere in your ledger account so that the examiner can see that you know that you're going to need to use this number, 105,750. I'm leaving it in brackets because that is not the final number yet. That is only the accumulated depreciation up to the 1st of July 2010. But you can see that we're selling the vehicle on the 31st of December 2010. That is why all our dates in the asset disposal account have got the 31st of December 2010. So what we need to do is we need to work out the additional depreciation from the beginning of our financial year, that is the 1st of July, up to and including the 31st of December when we sell it. But we need some more information before we can do that. Have a look at adjustment number H. It says, we must make provision for depreciation as follows. Vehicles at 15% per annum on the cost price. The cost price, you should remember, is quite a bit easier than doing it on the diminished balance method. So what we just need to do is we need to calculate the depreciation from the beginning of the financial year, in other words, the 1st of July, up to the 31st of December. Let's do that quickly. I'll give some space for the calculation down here. Remember, your formula for calculating depreciation is going to be the cost price multiplied by the depreciation rate over 100 multiplied by the number of months you've kept the asset divided by 12, because you're only keeping the asset for a fraction of the year. So let's think about how many months we have. We're selling the vehicle on the 31st of December, and we have depreciation up to and including the 1st of July. So the number of months that we have to calculate are July, August, September, October, November, and we're going to calculate December as well. So that's going to be 6 months of depreciation. So the number of months is equal to 6. The question also gives us the cost price of the asset that we are selling. We've already recorded that over here in our ledger account. So the cost price is equal to that 235,000 Rand. So if we want to calculate the depreciation, what we're going to do is we will take the 235,000 Rand. Our next step is to include the depreciation rate. So if we look back at the information we've been given, we've got the number here already. You see the number that we've circled, 15% per annum. So the depreciation rate is simply going to be 15 over 100. The final step is to multiply this by the number of months over 12. Number of months we've already counted is equal to 6, so we will multiply it by 6 over 12. Okay, let's bring up the calculator onto the screen and do the calculation. So it will be 235,000 multiplied by 15 over 100. I'm just putting the divide sign in there. Multiply by 6 over 12. And that's going to give us our answer of 17625. Let's write that answer down as the final answer to our calculation, 17625. Just to remind you what we've worked out here, this number is the additional depreciation from the beginning of our financial year up to the date of the sale, in other words, the 31st of December 2010. So what we need to do is include this number in our accumulated depreciation number. So we would have to add it to our 105,750 here, 17625, and that will give us the total accumulated depreciation on the date of the sale, and that is the number that we want. So let's add that up quickly. We'll take our 17625, which is still in my calculator, and I will add the 105,750, and that gives me the total accumulated depreciation of 123,375. And that's the answer that we're going to write in the credit column of this ledger account. 123,375. Now that we've done that, we need to include the next item in our asset disposal account. And once again, you need to know that the selling price goes on the very next line on the credit side of this ledger account. Let's go back to the information. You will see here that the selling price, remember I circled it earlier for you, the selling price was 90,000 Rand and we sold it on credit. Both of those pieces of information are going to be important here because the selling price we know is 90,000 Rand. You should remember that you will always record the selling price on the credit side of this account. I'm only leaving a line here because I've had space for my calculation, but it should actually go on the next line of the ledger. The next important thing is to know what to write in the details column. Now, there could be a number of different things that you'd write in the details column, depending on whether you've sold this asset for cash or whether you've sold it on credit. In this case, we have sold it on credit. There it tells us that we have sold it on credit. So what that means is that we cannot write bank in this account. Instead, what we have to do is we have to write debtors control, because we always write debtors control when we are selling a vehicle or a piece of equipment on credit. We're nearly done with this question. What we need to do now is calculate the profit or the loss on the sale of the asset. So what you do is you just balance this ledger account out. We'll need to see which side is bigger. So if we bring up our calculator again, I've got the 123,375 on the credit side, and I'm going to add the 90,000 Rand. That gives me an answer of 213,375. Can you see that the right-hand side of 235,000 is bigger than the answer I get when I add up the credit side? So the left-hand side is greater than the right-hand side. What we need to do now is then write the total of the right-hand side, the total of the left-hand side at the bottom. 235,000 Rand, 235,000 Rand. Now we need to put in the missing number that will balance this ledger account out. That's very easy to calculate, because all that we will do is we will take the 235,000, we will subtract the 123,375, and we will subtract the 90,000, and that gives me the balancing figure, which is 21625. Let me write it in here, 21625. And now, the last bit of information we need to include here is whether it is a profit on the sale of asset or whether it is a loss on the sale of asset. Here again, your theory is important. You should know that when the balance appears on the credit side, that is going to be a loss. So what you need to write in here is simply loss on sale of asset. And that's it. Our account is balanced. Both the debit and the credit side are equal to each other. We've calculated our loss, and we're done with this question. Now, the next question is going to require quite a bit more work than this first question, because the next question deals with the income statement. Let's have a look at what the question asks us. You are provided with the pre-adjustment trial balance. We know that already. And the question is asking us to complete the income statement for the year ended 30th of June 2011. But we don't need to do everything that we normally do in class exercises, because it says that the notes to the financial statements are not required. So we're only going to do the income statement. We also have to bear in mind that we must show our workings in brackets. So your first step in doing an income statement is always to look at the information that has been given to you and to put the numbers that you already know in brackets next to the appropriate description in the income statement. So what you should do is you should look at the pre-adjustment trial balance, which is given to us over here. Here's the information. And when we're doing the income statement, we're only interested in the nominal account section, because we know that the nominal account section is what's relevant to the income statement. So what you should do now is you should first write all of these numbers in the nominal account section in the correct place in the income statement, opening brackets as is required. So for instance, I'm going to take the sales number of 10,500,000 and I'm going to write it over here, 10,500,000, opening the bracket so that every number is already in the correct place. Now that is going to take you a bit of time, so maybe get started on that, and we'll come back after the ad break. Welcome back, everyone. I hope that you used the ad break to fill in the numbers that we know already, and I just want to highlight a few things. I filled them in the meantime. Very importantly, your first step in an income statement is always to take your sales number and subtract your debtors' allowances. So that's this 145,200 Rand over here. What you should do when answering this question is you should go back to the trial balance, and when you see this information, your very first step should be to take the sales number over here, and you should subtract the debtors' allowances of 145,200. I've done that already over here. I hope you did it as well. Also, there were two spaces for two operating incomes. The examiner was testing whether you knew that bad debts recovered over here and rent income over here were both operating incomes. So what you should have done is you should have written them under other operating income. I've also put in all the numbers that have been given to us under operating expenses, and it's very, very important for you to remember that interest has got its own special section at the bottom of the income statement. You can see here is the section for interest. We have interest income and we have interest expense. That is why when I was doing my filling in of the numbers, I took the interest income of fixed deposit over here, in other words, this 26630, and I did not include it in the subheading over here, other operating income. Why not? Because interest has got its own special place in the income statement. In fact, it appears at the bottom as interest income. So I wrote it myself over here, interest income, and simply transferred that number of 26630 in here. Right, now our income statement is prepared. We've put all the opening balances in brackets, and we're now ready to tackle the different adjustments. Remember that this is very important because usually for every number you write in the correct place, you're going to get 1 mark. So we've already got quite a few marks completed in preparing this income statement. Now, let's have a look at the adjustments and see what we should do. Our first adjustment is one that you should be familiar with. It's an adjustment that you should have already done since grade 10, and you should know almost immediately how to do it. It says, a physical stock taking on the 30th of June revealed the following inventories on hand. We have trading stock of 902,150, and we have packing material on 4260. What we do when we see an adjustment like this is you should immediately see that we are going to calculate either a trading stock deficit or a trading stock surplus in this question. And in the second part, in packing material, we know that this is your consumable stores on hand adjustment. Okay, so that's the first adjustment done. Let's have a look at the second one. The second one says that directors' fees of 22,500 are outstanding at the end of the financial period. All that simply means is that these directors' fees have not been paid yet. We owe those directors 22,500 Rand. So we could see that this would be an accrued expense. So, what's wrong with the number in our income statement? We've got 840,000 Rand for directors' fees. We've already written that number in the correct place in the income statement. But what's wrong with that number? Well, we still owe the directors 22,500 Rand. So all we have to do is add that 22,500 Rand to the number that we have. So it will be plus 22,500. You would also, if you were asked to do the balance sheet, you would also have to record that number as accrued expenses in the note on trade and other payables. But since our question is asking us to do the income statement only, we're only going to worry about this part of the adjustment. So we can calculate our new directors' fees and write them in the money column. It will be 840,000 rand. To that we're going to add the 22,500, and the answer comes to 862,500. That is the answer that we're going to write over here, 862,500. And those are the directors' fees that we actually paid the directors, or actually should have paid the directors this year. Our next question is adjustment C. This is one that I'm sure you've seen before quite often. It says, make provision for outstanding interest on a fixed deposit. This investment has been in existence for the entire year, and interest is not capitalized. We will see later on how to deal with interest that is capitalized. But if it's not capitalized, I'm sure that you know the formula for interest. What you would need to do is you would need to calculate the fixed deposit, and you'd have to multiply that by the interest rate over 100, and then you'd have to multiply it by the number of months over 12, just like we did when we were calculating depreciation. The good news, though, for this question is that the investment has been in existence for the entire year. So that means that we've had it from start to finish. In other words, we've had it for the whole year, so n is equal to 12. And we know that 12 over 12 is actually 1. So we don't actually have to worry about this part, because we know that we'll just multiply the answer by 1. So let's have a look at the information that we need. If we go back to our trial balance, here it is. Where is the fixed deposit? The fixed deposit is given here from Broadbank, and it's a fixed deposit with an interest rate of 8% per annum, and the investment is 495,000 rand. What we're going to do is we're going to calculate the interest that we should have received using this formula that I put on the next page. It is 495,000 rand invested at 8% for a whole year. So the calculation will simply be 495,000 rand multiplied by 8%, which is the same as 8 over 100. Let's do the calculation on the calculator. Should be quite straightforward. What we will do is we will say 495,000 multiplied by 8 divided by 100, and the answer comes to 39600. So what we do here, let me just write down the answer to the calculation so we remember it, 39600. That number is the total amount of interest that we have earned on this fixed deposit for the entire year. Now, once you've calculated that number, the next step is to compare it to the interest that you have actually received. So you see here, we've got interest on fixed deposit of 26630. We've only received 26,630 rand, but we should have received 39,600 rand. So there is some money outstanding. There is some interest that has not yet been received, and that interest would be called accrued income, because we have not received it yet. So how much is going to be accrued? Well, it's just going to be this 39,600 minus the number that appears in our trial balance. In other words, minus the part that we've already received, minus 26630. Let us put it in. Subtract 26630. And the amount that we are still owed on this interest is going to be calculated like this, minus 26630. So the answer comes to 12970. The bank still owes us interest of 12,970 rand for this fixed deposit. So let's write that number down, 12970. Now the adjustment is very easy. We just go back to our income statement, to the space where the interest income is, and we're going to add that 12970 because we've earned it this year. We may not have received it, but we've earned it this year. And that's the amount that we should have received. If you add those two together, we should actually get this answer of 39,600 again. So you can check that for yourselves. The answer for interest income comes to 39,600 Rand. Okay, that was that page of adjustments. Let's have a look at the next one. The next adjustment is one of these dealing with bad debts. It says that a debtor who originally owed 32,000 Rand has been declared insolvent. His estate paid 40 cents in the Rand, and this has been correctly recorded. In other words, this person went bankrupt, but he was able to pay us 40 cents for every 1 Rand that he owes us. What has to happen now, though, is we have to write off the remaining bad debt. It says that the remaining balance must be written off as irrecoverable. So what that means is he paid us 40 cents for every 1 Rand that he owes us. So the amount that must be written off is going to be 60 cents for every Rand that he owes us. He paid us 40 cents, but he owed us 32,000 Rand, so he paid us for every Rand 40 cents. That means for every Rand 60 cents must be written off. So the amount that must be written off is quite an easy calculation. We're just going to say 32,000 Rand times by 60 cents, which works out to 0.6 Rands. I'm sure you've seen these calculations before. They are usually covered in grade 10, and I'm sure your teacher has done them with you. Let's check what the calculation would be. We'll take 32,000 Rand, multiply by 0.6, and the answer comes to 19200. So that is the amount that must be written off. Let's record that answer here, 19,200. So out of the 32,000 that this person owes us, we have to write off 19,200 Rand. The other amount that he's paid, in other words, the 40 cents in the Rand, would also need to be recorded. But the question tells us that this has already been correctly recorded. So what we need to do now is just write off a bad debt of 19,200 Rand. The way you do that is very easy. You go to your income statement, you find bad debts, and all we're going to do here is add 19,200 Rand. So if we bring it up on our calculator, the total amount of bad debts are going to be that 19,200 Rand plus another 12,000, and the answer comes to 31,200 Rand. And that is the number that we're going to write in the money column, 31,200 Rand. What's important to realize, though, is that this number also affects debtors control. This person was a debtor, and he's vanished. He's not been able to pay us. So what we must remember to do is to subtract the amount that's written off from debtors control. That's going to become very important when we do an adjustment called provision for bad debts adjustment. So we need to just make sure that we do that. So I'm just going to record in our trial balance, which we have over here, I'm going to record that our number in debtors control has to be reduced, because out of this 396,000 Rand that appears next to debtors control, there's 19,200 Rand that we've just calculated that we are not going to receive. So actually, we should just keep track of this. It's 396,000 Rand minus 19,200 Rand. And that's then going to be the amount that we would have left over on debtors control. You're going to see immediately why this is important, because if you look at the next adjustment, this adjustment says that we must adjust provision for bad debts to 5% of book debtors. So we're making an adjustment on provision for bad debts to 5% of debtors. So our first step in doing this calculation is to work out what is 5% of our debtors. Can you see that we have just calculated a new debtors control number? The new debtors control number is this 396,000 over here minus the 19,200 that we've just written off. So when we are calculating what the provision should be, we should use this figure and calculate our new debtors control. So let's do the calculation. What we'll do is we'll type in our 396,000 and we're going to subtract the 19,200. That gives us the answer of 376,800. So our new debtors control, after that debt has been written off, is actually 376,800 Rand. So now, to do the provision for bad debts adjustment, we are going to need to calculate 5% of debtors control. In other words, it's going to be 5% of that number. So what is 5% of 376,800? 5% of 376,800. You should know from your basic mathematics that the word of always means multiply. So what we can do is we can take that 376,800 and multiply it by 5%, which is 5 over 100. And the answer comes to 18840. So that 18840 is what our provision for bad debts should be. We want it to be 5% of the 376,800, so we want it to be 18840. Now, what you need to remember when doing this provision for bad debts is that we're going to calculate the difference between the provision for bad debts that we have and the provision for bad debts that we want. We want our provision for bad debts to be 18840, but in the trial balance, it's already given to us as, let's find it, it's already given to us as 18,000 Rand. So there's going to be an adjustment. We need to change it. We don't want it to be 18,000 Rand. We want it to be 18,840. That's a calculation that you should even be able to do in your heads. You see, right now it is 18,000, and we want it to be 18,840. So the difference between these two numbers is 840 Rand. And this number is going to be the adjustment that we have to make in order to get provision for bad debts to equal what we want it to be. Now, your rule is that if the provision needs to be increased, the adjustment is actually an expense. If the provision needs to be decreased, the adjustment is an income. Now, in our example, the existing provision was 18,000. We need to increase it to 18,840. So because it is an increase of 840, that increase is actually an expense. So we're going to take that number and we're going to write it under the income statement, under the operating expenses section, as provision for bad debts adjustment. And just to show the calculation of how we got it, remember it was 18,840 minus 18,000. That's our new provision minus our existing provision. The answer comes to 840 Rand. So there are still quite a few adjustments that we need to do, but I think you've earned a break. Let's go and see a commercial. Welcome back. We've got quite a number of adjustments that we still need to do, so let's give it a try. We're now getting to adjustment G and adjustment H. In adjustment G, we did that in the first question already. You may remember that when we did the first question, we drew up the asset disposal account over here, and we calculated that there was a loss on the sale of the asset of 21625. Very, very important when you're doing a combined question like this is to identify that a loss on the sale of the asset is actually an expense to the business, and as such it has to be shown in the income statement. So what we need to do to complete this adjustment is we need to go back to our income statement, and in the operating expenses section we need to write loss on sale of asset, because that was an expense to our business. And we already know what the answer was because we've done the adjustment already. Loss on sale of asset. What we did is we calculated it as 21625. Here's the answer. that 21625 I'm simply going to record in my income statement as the loss on sale of asset. 21625. Now, some people might ask me, what happens if you've done your asset disposal account incorrectly? If you've made some or other silly mistake in this asset disposal account and you get the wrong loss on the sale of the asset? Well, the answer is, don't worry, you're not going to be penalized again. The examiner is going to check that this answer that you've written here in the income statement matches the answer that you calculated in the previous question, and you will still get the mark even if that answer is not correct. So rest assured, you're not going to lose any more marks in the next part of the question. But there's another thing that's important when we're dealing with asset disposal. What we always need to record in a financial statement is the total depreciation. And what you need to remember about depreciation is that there are always different aspects. You need to calculate it on sold assets, you need to calculate it on old assets, and you need to calculate it on new assets. So what's happening with these three, sold and old and new, we have to make sure that we do the calculation for depreciation. However, when you have done an asset disposal anywhere in the question, you've already calculated the depreciation on the sold asset. That is simply the additional depreciation that you added in this financial year. So in other words, you may remember from our previous question that we started off with 105,750 and then we calculated this extra depreciation of 17625. That's the depreciation on our sold asset for this year, and that has to be included in the income statement. So the second part of this asset disposal is to go back to the income statement and record under depreciation 17625. That's the depreciation on sold vehicles. Okay, let's look at the rest of the adjustment. We've already now done adjustment G, but adjustment H is important because it says that we must make provision for depreciation as follows. We must calculate depreciation on vehicles at 15% on cost price. You might say to me, but I've already done that. I've calculated this depreciation as 17625. Yes, that's true. You've done it on the sold vehicles. But remember, that was not the only vehicle that our business had. Our business had very many vehicles. As we can see from the original trial balance, we had vehicles to the value of 814,000 Rand. Here it is, 814,000 Rand. So, even though we sold a vehicle, we've still got some left over, and we need to calculate the depreciation on those vehicles that are left over. So remember the number 814,000. We're now going to calculate the depreciation on the old vehicles. It's an easy calculation if you know how. We know that vehicles are depreciated on the cost price. It tells us in the list of adjustments that vehicles are depreciated at 15% per annum on the cost price. So our cost price that we began the year with was the number I asked you to remember of 814,000. But now the problem is that we don't have 814,000 Rands worth of vehicles anymore. Why not? Because we sold one. We sold a vehicle to the value of 235,000 Rand. That is the cost price of the vehicle that we sold. So we no longer have the 814,000. We actually have 814,000 minus 235,000 because that vehicle is no longer with us. We have sold it. So our new cost price of vehicles will be the answer to that calculation. And then we still have to depreciate that at 15% for an entire calendar year. So let's calculate the answer to that sum. What I'll do is I'll take my 814,000 Rand. I will subtract the 235,000 Rand. And that answer I'm going to multiply by 15 and divide by 100. So the depreciation comes to 86850. Let me write that for you here. 86850. 850. That is the depreciation on our old vehicles, which needs to be included here, and we'll need to add it, plus 86850. But guess what? Those are not our only assets that we have. It's true that we didn't buy any new vehicles, but we also, apart from vehicles, have equipment. So when we're dealing with equipment, we need to look back at the depreciation method. Equipment is depreciated at 10% per annum on the diminishing balance method. So remember, you now need to take your cost price and you need to subtract your accumulated depreciation in order to work out what the diminishing balance is. Furthermore, it tells us that there was new equipment to the value of 48,000, which was purchased on the 1st of September, and this has been correctly recorded. This new equipment must be calculated separately. What we need to do is split the calculation for equipment up into old and sold and new. We don't have any sold in this example, but we do have new equipment and we do have old equipment. So let's do the calculation for equipment over here. If we're doing the calculation on the new equipment, we know the cost price was 48,000 Rand. How do we know that? Because the question told us. We also know it was purchased on the 1st of September 2010. And we know that it's been correctly recorded. So, if we purchased this on the 1st of September 2010, we had it for September, October, November, December, January, February, March, April, May, and June. We actually had this equipment for a total of 10 months. So, what we're going to do is we're going to multiply the answer by 10 over 12. The good news is that when you're doing new equipment, there's no depreciation yet. So it doesn't matter whether you're doing the cost price method or the diminishing balance method. The equipment is new, so it has no depreciation. So all we need to calculate if we want to work out this year's depreciation is the answer to the sum, 48,000 times by the depreciation rate, which the question gave us as 10%. And because we kept the asset for 10 months, we're going to multiply it by 10 over 12. Let's see what the answer is. 48,000 times by 10% times by 10 over 12. The answer comes to 4,000 Rand, and that is the depreciation on my new equipment. So once again, you've calculated that part of the answer. Let's put it immediately into our depreciation, plus 4,000 Rand over here. Right, there's one more thing to consider before we're done with our long depreciation calculation, and that is the old equipment. In other words, the equipment that we've had since the beginning of the financial year. Let's look back at the information. Here it tells us that the equipment was a total of 616,000 Rand. Now, that 616,000 Rand includes the new equipment that we purchased. How do we know that? Because the adjustment tells us that. The adjustment tells us that the 48,000 was correctly recorded. So to do the calculation, the old equipment consisted of 616,000 Rand, but we did not have that 48,000 at the beginning of the year. So we will have to subtract the 48,000 there. What's more, we still have to subtract the accumulated depreciation on this equipment, because depreciation is calculated on the diminished balance method. So we would have to go back to our trial balance and find the accumulated depreciation on equipment. Here it is. Just use a new color because there's so much green on this page. Accumulated depreciation on equipment, 341,000 Rand. That needs to be subtracted because we're doing the calculation on the diminishing balance method. So we still have to subtract 341,000 Rand. That's going to give us the carrying value of our old equipment. And that number must be multiplied by 10% in order to work out the depreciation on the old equipment. Very long calculation, but I hope you understand exactly what needs to be done. So let's do the calculation. It will be 616,000, remember the cost price of our old equipment, subtract the 48,000, which is the new one that we didn't have at the beginning of the year, subtract the 341,000, which was our accumulated depreciation at the beginning of the year, and that answer we're going to multiply by 10%. We don't have to worry about months because your old equipment is always for a whole year, so the answer comes to 22,700 Rand. Let's write that down. 22,700 Rand. And that is the depreciation on our old equipment, which we're going to add to this answer, 22,700 Rand. That's quite a lot of work, but it's worth it because each of these calculations gives you quite a few marks. Okay, we're very nearly done. Let's have a look at the final few adjustments. Okay, the next adjustment is adjustment I. It says the loan statement received from Joy Bank on the 30th of June reflected the following. Balance at the beginning of the year was this number here. Then there were repayments during the year. There was interest that was capitalized, and there's the balance at the end of the financial year. This is quite easy to do if you know how. When interest is capitalized, it just means it is added to the value of the loan. And if they give you a loan statement like this, it is actually quite easy to calculate the missing number. All we need to do is we need to look at the information we've been given on the loan statement. Can you see we started off owing 1,125,000 Rand. Then we repaid 458,000. So if we repaid 458,000, we would have subtracted this amount from the loan because we don't owe that amount anymore, we have repaid it. Then there was interest which should be added to the loan, and since we don't know what the interest is, we can put an X in there. And the answer to the sum is 804,500 Rand because that is the balance at the end of the financial year. So what we would do if we wanted to calculate what X is, we'd say that we started with 1,125,000 Rand. We repaid 458,000 Rand, and if we add the interest, which is X, we're going to get the final answer here of 804,500 Rand. Now it becomes very easy because all you have to do is solve for X. X is the interest that we want to calculate. So let's leave X on this side and take these two numbers over to the other side. So we already have 804,500. This was positive here, so it must be negative on the other side. Subtract 1,125,000. And this was negative here, so it must be positive on the other side. Add 458,000 Rand. So to calculate the interest now becomes quite easy. Let's quickly do the calculation. What we'll do is we'll take the 804,500 minus 1,125,000 plus 458,000. The answer comes to 137500. That is the number that must be added over here, where this X is, in order to get the answer of 804,500. And so that means that this 137500 is actually our interest on the loan. Let's just record it over here. 137500. And that's going to be the interest on the loan. So when we go back to the financial statement, that's going to be our interest expense. What you should do is you should show the calculation that we've done in brackets over here. So what you should do is you should rewrite this 804,500, the calculation that we did, should appear in brackets here. I'm not going to do it now just to save some time. And what we'll then do is we get the final answer of 137,500 as interest expense. And please remember that interest expense needs to be subtracted. 137,500, that needs to be subtracted because interest is an expense. Right, let's have a look at the final adjustment. The final adjustment in this question is the adjustment J over here, which is the adjustment on income tax. All they did is told us that the income tax is 150,285. So what we do with this adjustment is we just go to the income tax amount and we simply write the answer here again, remembering that it should be in brackets. 150,285. 150,285. Now we've done actually all the adjustments, so all you now need to do is calculate the answers to all of these brackets and rewrite them in the money column. Then, of course, you'd need to calculate your gross profit, which is sales minus cost of sales. You'd add your other operating income, and that would give you your gross operating income, and then you would subtract all your operating expenses, which you'd have to add together first, and that would give you your operating profit. Then you will have to add your interest income to get your profit before interest expenses. Then you would have to subtract your interest expense to give you profit before tax. Finally, you subtract your income tax, and that gives us the final answer, net profit after tax. If you've done this correctly, then your final answer should be 367. I beg your pardon, your final answer should be 387,675. So I'm going to leave it up to you to close those brackets and calculate the answers that should go in the money column. I hope you got it right, and I wish you everything of the best for your final exams. We'll see you next time. Good luck.